If you turn on any financial news network right now, I guarantee you'll hear it. This constant, almost breathless countdown. When will the Fed finally cut interest rates? It feels like the entire market is just frozen, holding its breath, waiting for that one signal. But today, we're going to ask a really important question. Is all this focus actually helping you? Or could it be your single biggest, most dangerous distraction? And this quote right here, it just nails the current mood. It doesn't matter if you're a seasoned trader or just getting started, the story everyone's telling is that a rate cut is the green light we've all been waiting for. The market's already reacting, you can feel it, it's pricing in all this optimism, betting that lower rates are going to fix everything and send stocks to the moon. It is the dominant story out there right now. But what if this whole thing is a trap? What if by pouring all our energy into guessing the Fed's next move, we're completely missing the bigger picture? What if we're looking for answers in the wrong place, and by doing that, we're setting ourselves up for a huge disappointment? Or maybe something even worse. Okay, so let's dive into it, this rate cut obsession. Before we can talk about why it might be a mistake, we have to get our heads around why everyone is so fixated in the first place. Why does the market hang on every single word that comes out of the Fed? Well, the theory itself is actually pretty simple. It's the kind of thing you learn in Econ 101. The basic idea is that lower interest rates act like rocket fuel for the stock market. When the central bank cuts rates, it gets cheaper for companies to borrow money and expand. And it gets cheaper for us to get loans for things like houses and cars. The whole economy gets a boost. And this is where it gets really interesting, because it's like a double whammy. First off, when borrowing is cheaper, companies can become more profitable. They're spending less on interest payments, so they have more cash to pour into growing the business. But second, and this is a little more technical, that interest rate is also used to figure out what a company's future profits are worth today. So when the rate is lower, all that money they're going to make down the road suddenly looks a lot more valuable right now. So companies are making more money and investors are willing to pay more for it. Sounds great, right? It's such a clean, logical theory. Lower rates should mean higher stock prices. It makes perfect sense on a whiteboard. But we all know the real world is almost never that neat and tidy. So the big question, the million-dollar question is, when we actually look back at the data, does this beautiful theory hold up? Does the market really reliably go up after the Fed starts cutting? And this, my friends, is where the story gets a whole lot more complicated. Let's start peeling back the layers here and see what the data actually tells us. You might be surprised to find out that these rate cuts are far from the magic bullet everyone thinks they are. The truth is, the link between what the Fed does and what the market does isn't some simple straight line. It's messy, it's full of nuance, and just assuming that a rate cut is an automatic buy signal is a really dangerous oversimplification. There are these huge, powerful forces moving under the surface that the daily headlines completely ignore. So why does the simple theory fall apart so often? Well, it really comes down to three key things. First, the market is always looking ahead. By the time the Fed chair actually steps up to the microphone to announce a rate cut, traders have been talking about it and betting on it for months. The move is already priced in, which means the big stock pop has probably already happened. Second, there's a serious lag. A rate cut today doesn't mean your mortgage is cheaper tomorrow. It takes months for these changes to trickle through the whole system. And third, and listen up because this is the most important one of all, the reason for the rate cut matters way more than the cut itself. This quote just says it all. You have to ask the question, why is the Fed cutting rates? They're not doing it to be nice or to give the stock market a little boost. They cut rates because their dashboards are flashing red. They see economic trouble coming, slower growth, people losing jobs, maybe even a financial crisis. The rate cut isn't a party starter, it's often the fire alarm. And if you don't believe me, just look at the evidence. The start of the last 3 major rate cutting cycles was immediately followed by some of the biggest market meltdowns in modern history. The Fed started cutting in early 2001, right as the dot-com bubble was bursting. They started cutting in 2007, right before the global financial crisis went into overdrive. And they started cutting in 2019, just before the COVID lockdowns brought the world to a standstill. In every single case, the rate cuts weren't a sign of good times ahead. They were a response to a disaster that was already unfolding. Okay, so if trying to trade around the Fed is this complicated, misleading game, what's the alternative? Well, there's a completely different school of thought, one that some of the most successful investors swear by. And it's pretty radical. It's just ignore them. This quote lays out a totally different philosophy. The argument here is that if your goal is to find those truly rare, world-changing companies, the kind that can go up 100 times in value, a 100-bagger, then the day-to-day macroeconomic noise is just that, noise. It's static. The Fed's latest decision, who's in office, trade disputes, none of it really matters in the long run for a company that has an amazing, unstoppable product. And this chart just perfectly lays out the two different mindsets. On one side, you have the typical market player, glued to the screen for every Fed announcement, reacting to every news headline, trying to guess the next big economic swing. And on the other side, you have the 100-bagger investor, doing deep dive analysis on great companies, focusing on their long-term vision, and truly understanding what they make and sell. It's a total shift from trying to be a market timer to becoming a business owner. I mean, put blindfolders on. That really drives the point home, doesn't it? The leadership at these great companies, they're not huddled in a boardroom worrying about the Fed. They're obsessed with making their product better, with serving their customers, and with building a business that can last. And the argument here is that your focus as an investor should be right there with them. So, this brings us to what might be the most crucial point of this whole discussion. The real danger for an investor isn't a certain interest rate or even a recession. The biggest trap of all is a psychological one. It's a state of mind that gets you stuck, and it's caused by focusing way too much on all that short-term noise. Let's put a name to it, the hold trap. This is a super powerful behavioral bias that gets so many people. It works like this. You buy a stock, and then it goes down. Suddenly, your thinking completely changes. It goes from, is this still a great company, to, oh man, I can't sell it now, I'd have to lock in a loss. You become mentally anchored to the price you paid. Then it drops even more, and the trap gets tighter. Well, I really can't sell now, I'm down too much. You're paralyzed. You just hold on and hope, even when all the signs say you should get out. And this is the bottom line, right here. The biggest threat to your financial future isn't what the Fed is going to do next month. It is your emotional, impulsive, short-term reaction to the news. It's letting fear make you sell at the absolute bottom. It's letting greed, fueled by rate cut hype, push you into a shaky investment at a high price. It's falling right into that hold trap because your decisions are being driven by headlines, not by a solid plan. All right, so if reacting to every headline is a losing game, then what's the right move? What does a smart, effective playbook actually look like? One that can help us beat these very human impulses. Let's build one right now. Here are 4 key pillars for a timeless strategy. First up, dollar cost averaging. This is your best defense against trying to time the market. You just invest a set amount on a regular schedule. It takes emotion and guesswork completely out of the equation. Second, play the odds, not the story. Historically, the market has returned around 7 to 8% a year over the long haul. Knowing that is like a shield that protects you from scary headlines trying to get you to panic sell. Third, focus on fundamentals. This is how you escape the hold trap. If you know exactly why you own a company, you can make a clear-headed decision to sell it if it's struggling or hold on if it's strong, no matter what the Fed is doing. And finally, stay objective. Especially in an election year, it's so easy to let your political views cloud your judgment. Just remember, your portfolio doesn't have a political party. It just cares about profits. And really, it all just boils down to this, doesn't it? All the short-term noise, the daily drama, the rate cut speculation, it all fades over time. What lasts is the power of great businesses growing and the magic of compounding your returns. Time and time again, a long-term focus is what wins. So I'll leave you with the same question we started with, but hopefully with a little more perspective now. When you look at your own investing habits, is the Fed's next move really your most important signal, or is it actually your biggest distraction? The answer to that could change everything for you. Thanks for watching.